This video has been produced to support community engagement about the rate options study for the Snowy Valleys Council. It's an opportunity to hear about the key issues and to provide feedback on your preferred options via the survey. Further information is available at the link shown on your screen. Your feedback will help inform Council's decision about a new rating structure for the local government area, which must be implemented from July 2021. It's important to note that these changes do not increase Council's overall rate revenues. The question is about a fair distribution of the rating burden across all ratepayers in Snowy Valleys. Local government ratings are a really complicated issue. We wanted to keep these videos short, but we also wanted to provide enough information that you can provide some informed feedback. There's a separate video for each of the four main land use categories: residential, farmland, business and rural residential. And this video also provides an overview of the detail in each of those. But I'd encourage you to have a look through this one first because it provides a bit more of a detailed explanation and introduction that will help you understand the information that's provided in each of these specific videos. There is also another video that's been produced to explain the impacts of the updated land valuations issued recently by the New South Wales Valuer General. This issue is distinct from the new rating structure, but it also impacts the rates payable by particular landowners. In fact, the impact on rates associated with these new valuations are in many cases more significant than the impacts of the new rating structure. The key question that Council's asking in this engagement is, what is the fairest rating structure for Snowy Valleys Council? And the answer to that is going to be a balance between what's often referred to as two key tax principles. Rates are a tax, they are not a fee for service, but the first of these principles is more of a fee for service idea. The benefits principle says that the people who are enjoying the benefits of Council's services should make a contribution to the cost of those services. The second of these, the ability to pay principle, is more of the tax idea. So it says that those with a greater ability to pay should pay more, those with a lesser ability to pay should pay less, and those with the same ability to pay should pay the same amount. So the key tax principles is the theory behind the rating structure, but the practicality of it is that there's only a couple of levers that Council can adjust to vary the rates that people pay in order to make the rate. So the easiest way to explain these will be just have a look at the example of the current rating structure with residential. So firstly, in Tumut, you can see here the relationship between rates and land value. So as land value goes up, the rates go up, and that's what's known as the ad valorem rate, or rate in the dollar. But in each of the categories in Tumut, there is a $540 minimum rate. So you can see that below a certain threshold, here with residential it's about $53,000, everyone pays $540 regardless of the value of their land. The former Tumbarumba Shire Council used the other option available under the Act, which is a base rate. So you can see here that everyone pays $232 as a base rate, and then the ad valorem is applied on top of it. When we compare the two, the system in Tumbarumba is arguably fairer. In Tumut, everyone below that $53,000 threshold pays the $540 minimum rate, regardless of the value of their land. In Tumbarumba, everyone's paying that $232 minimum, so everyone's making a contribution for the benefits that they enjoy, the services Council delivers, which is really the thinking behind the minimum rate. The rates are also going up with land values, so that's the ability to pay principle coming in, whereas with the minimum rate, everyone's just paying the same amount regardless of land values. So in view of the fact that the base rate structure used in the former Tumbarumba Shire is arguably fairer than the minimum rate used in the former Tumut Shire, the options that we're looking at are focused on a base rate structure. The key question though is how much of the overall rate revenues should come from the base rate that everyone pays, and how much should come from the ad valorem rate that goes up with the value of properties. And again, the best way to consider the issues behind this is to look at an example, and again we'll look at the residential category. So this is back again to the chart showing the difference in rates payable in each of the former shires depending on the land value. So the first case we'll look at is a 50% base rate. That's the highest that's allowed under the Local Government Act. It's worth noting that the purple line is parallel to the red one, and what that's telling us is that the former Tumba Shire had a 50% base rate. The difference between the two is the increase associated with harmonising the rates with Tumut. The second case is the 25% base rate, which is option C under residential. And you can see that that lower base rate is increasing the ad valorem rate, the steepness of that line. And so rates on properties at the lower end of values are going down and rates on properties at the higher end are going up. So let's compare the rates that are levied on a couple of blocks, one worth 40,000 and another 80,000. With a higher base rate, the gap between the two is about 40%, but with a lower base rate, the gap widens out to about 67%. And the key question then, in terms of what's fair, is how much extra should someone with a more expensive block pay in rates? Particularly given that there's not a strong correlation between people's ability to pay and the value of their land. And the easiest way to explain this is to look at the available tax information on incomes in different towns, and incomes are a very good indicator of ability to pay, which is why they're used to levy income tax. But when we put that alongside the typical land values in each town, you can see that there's not a strong correlation at all. So that's the issue with relying too heavily on land values as an indicator of ability to pay. So if we think back to the key tax principles, where the benefits received by different ratepayers, the cost of the services the council provides to them, is fairly similar, which is arguably the case with residential land, then a high base rate that evens out the rates paid on low and high value properties is arguably fairer. But in situations where there's a significant difference in the benefits received by different ratepayers and in their ability to pay, and a good example here is a very large farm versus a very small farm. The large farm will generally have a lot more trucks moving in and out and using council's roads, and that all costs money to maintain. The owner of the large farm is also likely to have a greater ability to pay. Then it's arguably fairer to use a low base rate that increases the difference between the rates paid on low and high value properties. But that's not to say there should be no base rate, because that shifts all of the rating burden onto the higher value properties, and it means that the low value properties are paying very little or making very little contribution to the cost of the services that they're enjoying. Here we come to the second key question in terms of a fair rating structure. How much difference should there be between the rates that are paid by residential ratepayers and farmland and business ratepayers? The chart here shows one of the detailed bits of analysis that's in the rate options study, and it compares the benefits received by different ratepayers for each dollar of rates that they pay in. It's important to note that there's a set of assumptions behind this information, and the details of those are in the rate options study. But as you can see by the difference in the height of the lines, there's a fairly clear distinction between the different categories. And that's really what we're after, an indication of who's paying more, who's paying less. But bearing that in mind, what this information is suggesting is that residential and rural residential ratepayers are getting a very good bang for their buck. They're getting about $1.40 in services for every dollar in rates that they put in. Farmland and business ratepayers, on the other hand, are only getting about 70 cents worth of benefits back for each dollar of rates that they put in. But it's important to think back to those key tax principles. The benefits that people receive is only part of the story. The other part is the ability to pay. So the main way council evaluates people's ability to pay in its rating structure is the value of their land. So what we can do alongside the comparisons of the benefits received is we can look at the effective tax rate that council levies on land in each of these categories. And that's shown in the purple bars in this chart. In the rate options study, I did an analysis based on the effective ad valorem rate on a typical property of median value, but here I'm using a tax rate on the value of land, which is calculated by dividing the rates by the value of the land, because I think it's easier to explain in this context. The key thing that jumps out here is that the tax rate on business land is far higher than any of the other categories. So even though both farmland and business are getting less for their money in terms of the benefits principle, the rating structure is assuming that the business ratepayers have a far greater ability to pay relative to the value of their land. And meanwhile, for farmland ratepayers, while the benefits that they receive are less than the rates that they put in, they're also being taxed at a far lower rate than any of the other categories. In the video on the business land use category, I'll explain why I've recommended that Council redistribute about 10% of the rating burden from the business category to the other categories, which would see rates in those categories go up by about 1%. The other thing that jumps out in this chart is the significant difference in the tax rate between ordinary residential land and the rural residential subcategory. It's reasonable to assume that these ratepayers both have a similar ability to pay. They both receive similar benefits. So it begs the question why they shouldn't pay the same amount of rates. Obviously, though, if the rural residential subcategory were to be eliminated, then the tax rate on that land would go up, and so would the rates. That brings us to the third key question in the conversation about the fairer rating structure for Snowy Valleys: how much emphasis we should place on minimising the impacts of any changes on ratepayers compared to the rates they pay now, and how much emphasis we should place on developing the fairest rating structure into the future, one that is not going to entrench the inequities in the current system. And rural residential land is a case in point here. As I've just noted, the tax rate on rural residential land is far lower than for ordinary residential land, but if we address that inequity, it will end up costing the rural residential ratepayers more. So before making a decision on rural residential land, it's worth considering why each of the former councils introduced the subcategory in the first place. So starting in Tumbarumba, the rural residential subcategory was used, as subcategories are used in most councils, to even out the rates paid on the lower value residential land and the higher valued rural residential land. So even though the typical rural residential property is worth 2.5 times that of the typical residential property, the rates paid on the rural residential is only 1.5 times as much. This was possible though because there was a reasonably clear distinction between the lower value residential and the higher value rural residential. In the former Tumut Shire, there's a significant overlap between the two, as can be seen in this chart. And when both of these charts are combined, it's clear that there is a significant overlap for Snowy Valleys between the value of residential and rural residential land. So if we draw a line at, say, $86,000, which is the value of the typical rural residential block in Tumbarumba, there's actually almost 1,000 residential properties valued over that amount in Snowy Valleys. But there's less than half of that number of rural residential properties over 86,000. So the question then is it fair for these higher value rural residential properties to be paying around 20% less in rates on land of the same value? The trouble is, addressing this does result in some considerable increases for the rural residential ratepayers. The history of the rural residential subcategory in the former Tumut Shire is quite different. Up until a special rate variation was introduced in 2005, there was no rural residential subcategory. Everyone was in residential. The then council introduced a special rate variation on the basis that no one would pay more, and offset the increases associated with the SRV with lower water and sewer charges. So the rural residential subcategory was simply those residential properties not connected to water and sewer, and so not benefiting from the reduction in water and sewer charges. While this approach was in some respects understandable, it was a red herring. The ordinary rates are not related to the water and sewer charges. Councils need to run these two operations as distinct businesses and generate the revenues from these areas to pay for these services. The reality is that the rural residential ratepayers in the former Shire have paid 36% lower rates for the last 15 years. When the special rate variation was introduced, the only ones that paid more were the residential properties and the business properties. Another complication of this history is that almost half of the properties that are classified as rural residential are non-compliant with the requirements of the Act, which says that they can only be classified as rural residential if they are larger than 2 hectares. So when this special rate variation expires, these properties need to return to the residential land use category anyway. So considering the current situation in each of the former councils and the history behind the rural residential subcategory, the option of eliminating a subcategory is one worth considering in the context of this whole process. But the key issue then is what is the size of the increases that would be felt by individual rural residential ratepayers? Explaining this is a good opportunity to run through one of the key components of the more detailed rates videos, and that's using a set of charts to more clearly show the impacts on ratepayers with land of different values in each of the former councils. So this first chart just shows the current rating structure in each of the former councils. I've then overlaid a line showing the rates that would be paid on land of different values with a 33% base rate, and you can see that the green line is quite a bit higher than both the blue and the red, which says that the rates that would be paid, particularly up the higher end, would be considerably more. The chart I've added at the bottom shows the distribution of rural residential land in former Shire of different values. You can see there's a fairly even spread of properties valued from right down the bottom end up to about 180 grand. The blue line I've added at the bottom then shows the impact in percentage terms on ratepayers of different land values. And you can see that as the rates go down in Tumut at the lower end of property values with the elimination of the minimum rate, that there are considerable savings at the lower end of the property values of up to 40%. Then in the mid-range of values, there's some considerable increases of approaching 40%, which it's worth remembering is about the premium that the residential ratepayers have been paying over and above the rural residential for the last 15 years. Then at the higher end of property values in Tumut, the increases come down to around 15%. If we then move on to look at Tumbarumba, we can see that there's still a considerable distribution of property values from the lower to the higher end. But it's this chart here that's the real worry. What this red line is showing us is that the increases at the higher end of property values in Tumbarumba would be around 45%. The increases are reasonably minimal down the lower end of property values because the base rate is lower. But what this chart reinforces is that if council was to eliminate the rural residential subcategory for the reasons outlined in the history earlier on, then it really needs to have a higher base rate to even out the rates between higher and lower valued properties. And that's what's shown in the chart here. Option A in the survey is to use a 50% base rate. You can see that's far closer to the current rating structure in Tumbarumba, with the purple line being almost parallel to the red line. And when we compare the two alongside one another, you can see that what it's doing is pushing up the rates at the lower end and pushing down the rates at the higher end. And when we add that second chart showing the impact in percentage terms on ratepayers with different land values, we can see that increases at the higher end have come down considerably. It's important to note that even though the red line shows that the increases experienced at the lower end of property values are now more than those at the higher end, we're talking in percentage terms in the chart at the bottom, and the dollar value increases, which are shown in the chart at the top, are actually far more significant, almost 3 times as much for the higher value properties. So this example was an opportunity to highlight how difficult some of these decisions are, and the need to balance out a fairer rating structure for the future against some people experiencing significant increases as it's phased in. And that's where the rate options study does recommend that Council explore options to reduce the impact on people by, say, only having increases of a maximum of 10% per annum as we move across to the new rating structure. So just quickly summarising the key points in this video, the question of the fairest rating structure for Snowy Valleys Council needs to be a balance between the benefits principle, everyone making a contribution for the value of the services that they enjoy, and the ability to pay principle. People with more ability paying more, less ability paying less, and equal ability paying the same amount. And as we saw, there were three key questions to consider as part of this process. Firstly, the proportion of the base rate versus the ad valorem rate. We saw that for residential land, it makes sense to have a higher base rate, where for farmland, a lower base rate is arguably fairer. The second question we looked at was around differential rating. So how much of the rating burden should different land use categories bear? And we looked at the proposal to shift 10% of the rating burden from business to other land use categories. And the third question we looked at was whether we should be focusing on minimising the increases for ratepayers compared to what they're paying now, or determining what the fairest rating structure is moving forward into the future. And we saw that that is a real concern and something to be discussed in relation to rural residential land. So thanks for taking the time to watch this video and hear a bit more about what's come out of the rate options study. I'd really encourage you to complete the survey and to check out the further information available on the Your Voice Snowy Valleys website, which is available at the link below. Thank you.